It's a race between optimism and risk. Asian stocks and U.S. futures are pushing higher on hopes of a Fed rate cut in December and a potential breakthrough for Nvidia's AI chip sales to China. But that sentiment is fragile. Geopolitical developments are brewing that pose a significant and immediate threat to the global rally. Live from Tokyo, this is Insight with me, Sherry An. The biggest spat between Japan and China in years is getting testier. Tokyo calls Beijing's claims on its Taiwan stance totally baseless, while China accuses Japan of crossing a red line. Oil prices drop further as traders weigh the prospect of a Ukraine-Russia peace deal. But Secretary of State Marco Rubio says President Trump's Thursday deadline for Kiev to back his plan isn't set in stone. Controlled Risks partner Angela Mancini joins us with her assessment of how these geopolitical stress points could play out. From AI bubble fears and the Fed to China's reluctant consumers, we discuss market tensions with BNP Paribas Wealth Management's Grace Tam and Goldman Sachs China portfolio strategist Si Fu. We're tracking an advance in the Asian markets today after U.S. markets close out a volatile week in a positive note on Friday. The outlook is brightening for potential Fed rate cuts, with New York Fed President John Williams sounding a dovish note.
I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals.
And on the geopolitical front, U.S. Secretary of State Marco Rubio says President Trump's proposed deadline to secure Ukraine's support for a U.S.-backed peace plan by Thursday isn't set in stone. According to the White House, Ukraine believes the current U.S.-backed peace proposal reflects its national interests. Rubio's comment comes after U.S. and Ukrainian officials met on Sunday in Geneva, and European leaders discussed Trump's proposal on the sidelines of the G20 summit.
Ukraine has never wanted this war, and we will never be an obstacle to peace. Diplomacy has been reinvigorated, and that's good, very good. We expect that the outcome will be the right steps. The first priority is a reliable peace, guaranteed security, respect for our people, respect for everyone who gave their life defending Ukraine against Russia aggression.
Rising geopolitical tensions also top of mind at the G20 meetings in Johannesburg. Japanese Prime Minister Sanae Takaichi notably kept her distance from Chinese Premier Li Qiang as their countries navigate a diplomatic spat over Taiwan. Let's bring in our China correspondent Min Min Lo with the latest on this. And Min Min, really, both sides seem pretty determined not to back down.
That's right, and it's a missed opportunity for both sides, right? They were both at the same place at the same time. Premier Li Qiang was there along with Sanae Takaichi, but China was clear that it did not intend to meet with Takaichi. And when asked by reporters, Takaichi said she didn't have a chance to speak with Li Qiang, but she says this by no means is saying that Japan is closing the door on dialogue with China. In fact, they're calling for dialogue as China had just submitted over the weekend a letter to the UN vowing to defend themselves rigorously if Japan dares to intervene militarily, clearly trying to rally support for its stance here. But Japan is dismissing any claims by China that its own stance on Taiwan is changing. It's dismissing that as completely false, basically. And, you know, we're seeing this war of words ramping up online as well on X, the Chinese embassy in Japan saying that it is able to defend itself without requiring the approval of the UN, citing a World War II era clause on enemy states that apply to Germany and Japan. But of course, Japan is saying that this is considered obsolete by now.
And it really won't help that Japan's defense minister just visited a military base close to Taiwan.
That's right. And this is a military base on the island called Yonaguni, which is just 100 or so kilometers east of Taiwan. And on a clear day, in fact, you can probably see Taiwan with your naked eye. So a very strategic location for Japan to have a military base. And the Japanese defense minister is saying that they're planning to deploy missiles to that area. Now, we all know about the larger Okinawan island that is further east that hosts a U.S. military base. And recently, a U.S. training had also moved some supplies from Okinawa to Yonaguni. And of course, this is something that will likely provoke China to potentially retaliate as well. China has not responded so far, but I wouldn't be surprised if China decide to, come up with their own military sort of rehearsals close to Japan's territory as well.
Yeah, we'll be watching out for that. Bloomberg's China correspondent Min Lo. Let's also get perspective from Angela Mancini, partner at Control Risks. Angela, great to have you with us. Where's the circuit breaker in this diplomatic spat between China and Japan?
Yeah, we're all hoping that there is one soon. It's hard to see where there would be one in the immediate term. I think neither side is looking to have anything inflame further than it is. It is indeed unfortunate the way things have played out. But indeed, as Japan has indicated, there is no intention on the Japan side to actually be changing their policy. And so far, what we've seen from the China side has not been too strong in terms of things like actually changing trade relations or any of the agreements and things around seafood so far yet. So it is a moment of tension. We think going forward, we're going to unfortunately continue to see this same period of heightened tension, but hopefully nothing will inflame the situation further. But it's hard to see an immediate off-ramp, at least for the next few weeks.
I mean, you said we haven't seen drastic measures coming from China, at least on the economic side so far. But going into this spat, who has the upper hand?
Well, it's hard to characterize it precisely like that. The Japan does need China much more than China needs Japan as it relates to trade. So Japan gets about 20% of their trade from China, whereas the other is about 25% of that. But the real issue here is what we take from a kind of a broader standpoint is this speaks to the fact that in Asia, as we talk about security hotspots, we're always talking about the U.S. and China. When we talk about trade hotspots, we're always talking about the U.S. and China. The reality is there's a lot more markets aside from just the U.S. and China to consider, in this case, Japan. And so if you do have a situation where, especially leaders knew, if something is said that may be said in a way that they wish it hadn't come out precisely like that, then it's going to be a challenge for how the relations go. I think the real issue here is Takaichi comes to this premiership with a history of being perceived by China as being very hardline on China and very receptive to Taiwan. And in fact, she posted on social media her recent meeting with the Taiwan APAC representative. So they're primed on the China side to see what she says in a light that may be more provocative than she intends it.
I want to get to Takaichi herself as well, but to your earlier point about these diplomatic spats, trade spats happening even within the region, not necessarily between U.S. and China alone. What does that tell you about the future of trade at a time when we have seen during APEC, during ASEAN meetings, that these regional powers have tried to come together in order to counter the U.S. tariffs, but at the same time you have tensions and friction on their own issues, whether this is territorial, historical, and so forth?
Yeah, it's very complicated. It's, 3D chess, 4D chess, because you've got, all these countries are trying to figure out what makes sense from a trade perspective, with the U.S. continuing to be an ongoing disruptor in that regard, while also dealing with the security hotspots around the region that we've had for some time. But then you also have new opportunities opening. I mean, we saw over the weekend India, Canada, and Australia getting together as it relates to issues around green tech and innovation and trade. So there's an ongoing change around Asia Pacific, around things like trade that then, of course, are looked at to some extent through a security lens as well. So lots of complexity, lots of moving parts. And indeed, the old rules, as it were, are not there anymore as strongly as they've been in the past in terms of precisely how bilateral relations stand. So I think it's a very challenging time, particularly for a newer leader like Takaichi coming in, or any new leader, where they're trying to find their footing amidst this very complex trade and security outlook for Asia. But then also, of course, they have their own domestic constituencies to think about as well. And no leader wants to be able to be seen by their domestic population as being, too weak as it relates to trade or security issues.
And Takaichi having come to power in that nationalistic tone, we are now seeing the Yomiuri poll latest to come out this morning showing that her cabinet's approval rating is still at 72%, which is pretty high for a Japanese prime minister. Will she just double down here because she's also talking to her own constituency?
Yeah, she does. I mean, your statistics are exactly right. And she has definitely said she does not intend to recant what she said per se. I think the broader issue for example, the Japanese business community is questions around not just what it means for trade relations with China, but what it also means for security and safety of Japanese businesses and travelers on the ground in China. So that's another area from a business risk point of view that companies are looking at, given the history back in 2012 of some issues that happened in China as it related to Japan, and then the backlash that happened with Japanese businesses there. But I think both sides don't, again, have the intention or interest to make things more intense than they are now. But I think it is going to be a period of a few weeks before we see the opportunity for any immediate off-ramp. And I think also from the China perspective, I would imagine that they would be not wanting things to inflame further from their side if they can do, because, of course, the relationships with the U.S. and Japan are quite strong. And so, again, it just gets very complex in terms of what those alliance relationships are and what it implies for things like, again, the rare earth situation. So Japan relies on critical minerals and rare earths from China, particularly for their auto industry. And they really, from the Japan side, don't want to see anything impact that. And China, I don't think, would be keen to have anything inflame the recent agreements they've had with the U.S. on that same issue. So it is a complex time, and I think just speaks to the fact that, again, if you have one comment that's taken in a certain way or that's said, it just has the ability to really impact a lot of different countries as it relates to trade and security.
Any more weaponization of the rare earths issue by China, though, that could backfire on Beijing, right? We have seen them already make this an issue back in 2012 for a couple of months, restricting those exports to Japan, right? But right now, it seems the geopolitical landscape has changed. And as you mentioned, there's much more focus, especially coming from the U.S., especially after the sort of temporary truce having been established already.
Yeah, so right now, as it stands, given the recent meetings and agreements between the U.S. and China, that particular issue seems to be more quiet. But I think the real issue here that we're seeing from our clients around Asia is other countries looking at China's reaction to Japan in this case. What do they say and what do they do as it relates to things, again, potentially including rare earths down the road if it gets to that? Because I think they'll look at that as an indication of how China reacts when they are unhappy with the state of play as it relates to, again, trade or security issues for themselves. So it is, Japan is keen to make sure that rare earths, critical minerals stay flowing to Japan. So is everybody. And many countries are thinking, what could their plan be? But it's not so simple to diversify. And so, again, a situation like this, to me, just speaks to the overall complexity on both the trade and the security side and what other countries and other companies must do in order to make sure that supply chains are resilient and they're really keeping track and a watching brief on these risks as they develop.
I also wonder, is Beijing trying to test the waters with Takaichi and how far she can go on her hardline stance against China, especially at a time, though, that it seems even the Japanese public is not too happy with the inflow of Chinese tourists, giving Takaichi a stronger hand when it comes to pushing for these nationalist policies?
Yeah, I think that I don't really see that China's trying to deliberately provoke Japan. I think they, again, as I mentioned earlier, there is, from what we understand, a sense on the China side that she comes to her premiership like with a position similar to Abe, her mentor, that is more hard-lying as it relates to China issues and more supportive of Taiwan, and we've seen that in her statements and again in her social media. And so I think China is certainly looking for and kind of primed to react if they see anything that they would deem as a change of policy. But it doesn't appear to us that they were seeking any deliberate provocation of her. And in fact, it's probably the last thing we would need from China's perspective and everyone's perspective is yet a further flashpoint or a further inflamed point along the hot spots we already have. So it's more, I think they're very much hoping she recants, but it sounds like she won't.
Let's talk a little bit about that other hotspot that we're also watching this week with the U.S. peace plan for Ukraine having that deadline of Thursday. Where do you think this will go from here? Is this something that the Ukrainian president can actually accept?
Well, I think the Ukrainian president, unfortunately, is in a very, very tough position, given, of course, where things stand in the battlefield now, but as well as the corruption scandals at home and just the way the war has been playing out. But certainly, as he has said, there's Ukrainian dignity to bear in mind. I think the real issue is what's going to happen on the European side, because as we've seen French President Emmanuel Macron say, and is echoed by others, it's Ukrainian sovereignty, but it's European security. So we at Control Risk have offices and clients all across Europe, and they're very focused on this situation and what it might potentially mean for security going forward across all those countries, all the companies, the supply chains, and safety and security of people and assets around the region. So I think one issue is what Ukraine is pressed to have to do. But it's going to be very interesting to see in the coming days whether or not Europe can really gather together and press back on President Trump, as they did before. I mean, as we know, we've been here before. This is a conversation that we've been having over a period of months. I mean, back in August, the Europeans and Ukraine met together with President Trump, and Trump walked out of that meeting and we all thought that things were going more for the Ukrainian side, and now things have flipped back. So it does seem that from the U.S. side, President Trump, as is indicated, is quite weary of this conflict and ready for it to end. But it's not so simple, and certainly not if the Europeans aren't actively involved in the discussions, and certainly if there aren't things like very basic things like the U.S. has put in this agreement that the Ukraine should cap its military at 600,000. Europeans and the Ukrainians do not want a situation where you're setting precedent, where you're capping a sovereign nation's military.
How closely aligned do you see the Europeans with Ukraine right now? Because we heard from Bloomberg reporting that the U.S. doesn't want the Europeans and the Ukrainians to meet together. That Washington doesn't want to meet them together. It seems like a strategy to have negotiations separately that could be more beneficial to an outcome that Washington wants.
Yeah, that's absolutely true. The U.S. has indeed said they don't want to meet them together. I think they think that if they meet Zelensky on his own, it's easier for them to kind of really push through the peace plan that's been put together by, it looks like, the U.S. and the Russians. But the Europeans don't want that. The Ukraine doesn't want that. And then there's also a matter of, a lot of the U.S. public and U.S. Congress also, there's a lot of Russia hawks in the U.S. Congress. And so I'm really interested to see, particularly as President Trump's in a bit of a tough period domestically at home now, how strong is the pushback on the U.S. congressional side around the perception that the U.S. might be just taking a heavily Russian-written plan and taking that forward if that is indeed the perception. So I do think that the Europeans will push hard to be included. If they can't be included, they're certainly going to push back hard on the points that they see as critical for European integrity as well, security integrity. And I wouldn't be surprised if we have, if this doesn't come to pass as a signed, inked agreement by the time period they're saying could be next week. I wouldn't be surprised if that doesn't happen, and we, continue to push things down the road.
Angela, just super quickly, can America accept security guarantees for Ukraine like NATO's Article 5?
Very difficult to answer that question. I think that the U.S., of course, will push back on that. I think they're in a very tricky position right now vis-a-vis Europe, Ukraine, and Russia, and I don't think President Trump is anxious to be stating actively security guarantees for Ukraine, given the current political situation. That may be a different position that you hear from Russia hawks in the U.S., but clearly President Trump wants this issue off the docket and to move on. But it's, this has been going on for years, not easy to solve, very hard to see how this comes to pass. And the last thing I'll say briefly is all the other peace agreements and trade agreements we've seen out of the U.S. have very little in the way of details, and they tend to fall apart quite quickly. So even if something were to be signed next week, it would be a question of how long it would be lasting.
Yeah, the devil is in the details. Angela Mancini, good to have you with us, partner at Control Risks. Coming up, BHP walking away from Anglo American yet again after its latest approach flounders. Details of that next. This is Bloomberg. Mining shares in Australia gaining ground after BHP said that it was no longer considering a revived takeover of Anglo American. Let's bring in Bloomberg Metals and mining reporter Paul-Alain Hunt. Paul-Alain, what happened this time?
Well, it was only a year and a half ago that we saw BHP take its initial bid for Anglo. Over the last, just yesterday, Sunday, from our London bureau, we broke that BHP had returned for another crack. However, just as soon as we'd written those stories, this morning we woke up and found BHP had walked away from Anglo yet again. At the heart of it is copper, the red metal that is key for electrification, for data centres, for decarbonisation. BHP sees that as a premier growth opportunity for itself, that and potash, but it sees copper in particular prices soaring and demand going as high as 70% compared to where we are today by 2050. So these are extraordinary numbers. That's what's been behind these bids. And the other thing is there's not a lot of copper stocks with large quality portfolios of copper projects. So Anglo was one of these stocks that BHP really thought, look, this is an opportunity. However, Anglo is now trying to combine its business with another copper company called Teck Resources, and that shareholder vote is coming up in a couple of weeks. So BHP, this bid was, or this approach was really seen as the last roll of the dice for the company.
Right. So what is BHP going to do next then?
That remains to be seen. Look, BHP really does care about copper. There was very little detail in the announcement today from BHP after we had, of course, broken the news. We know that it was scrip and cash, or shares and cash, but they didn't announce a premium, so we don't know whether this was 10, 20, 30% or higher. Copper stocks are valued a lot higher than the diversified peers. And BHP does have opportunities in its portfolio for organic growth. It's said that it's going to look at organic growth, but its main projects are greenfield, right? So it's got a project called Resolution in the US, and it's got Vicuña in Argentina, but those are new mines, and they can take up to a decade to develop, or much longer, even decades. So it's really in a bit of a sticky situation. Meanwhile, its Chilean copper mines are starting to turn into lower grade ore. Extracting everything is becoming harder and harder.
Bloomberg Metals and mining reporter Paul-Alain Hunt there, joining us from Melbourne with the latest on what can we expect in the mining sector. But also in Australia, we're tracking a big jump in shares of logistics firm Cube Holdings after Macquarie Asset Management offered to buy the company in a deal valuing it at about $7.5 billion. Even so, the gains are well short of Macquarie's cash offer per share, which is at 28% premium to Friday's close. The gap may be reflecting the numerous conditions tied to the deal and the lengthy time frame before completion. Coming up, BNP Paribas Wealth Management Hong Kong joins us to unpack how tourism and retail stocks have been impacted by ongoing China-Japan tensions. This is Bloomberg. Welcome back. You're watching Insight. Take a look at how we're setting up in the Asian session as we head towards China going on a lunch break. We're watching those Chinese chip stocks very closely under pressure as we heard from U.S. officials that they're beginning early discussions on whether to let NVIDIA sell its H200 AI chips to China. That could dampen sentiment for local substitution makers. We're following that sector very closely as we head towards the lunch break. And of course, it's also earnings season in China. Do watch for Alibaba, Meituan, all reporting this week. We're expecting a profit erosion to be shown in these results. Also across the board in Asia, a little bit of a mixed picture. Japan away on holidays, but we continue to watch the Japanese yen. Of course, we have seen that incredible pressure still at around those January lows against the greenback when it comes to the Japanese currency. A lot to do with the ongoing diplomatic spat between China and Japan, and the new Prime Minister Takaichi, of course, having those conversations internally on how to respond. But the Indian rupee coming online after falling to an all-time low against the dollar, we had seen it becoming the worst performing currency this year, down more than 4%. And we're now hearing from traders that India's RBI is selling dollars offshore, likely to support the rupee. We have seen losses accelerating after policymakers were surprised by the RBI actually not choosing to prop the currency, and it breached that 89 level against the dollar after aggressive interventions in mid-October. But we're now hearing from traders that the RBI is selling dollars offshore. Another company that we're watching in Taiwan is Foxconn, aiming to spend an initial $1 to $5 billion growing its U.S. manufacturing footprint. The expansion is aimed at meeting the needs of AI firms such as NVIDIA and OpenAI. Chairman Young Liu laid out the firm's plans with Bloomberg.
The gigawatt per week will be the goal.
Okay, 1 gigawatt per week.
Per week. That will be same goal. Okay. But we can start with 1 gigawatt per month.
So you think you can add 1 gigawatt per month next year?
Starting the second half of the year.
Second half of the year, so you think you can add 6 gigawatts next year?
I'm not sure. It really depends on our study and our new way of doing things. It takes time, but eventually we're going to get there.
Let's talk about then this opportunity in the US, because as you said, the part of this is about Make in America. It's very ambitious. What's the capex that you need to also dedicate to the States?
The capex-wise, it's in maybe 1 to 5 billion to start with, to build the factories, to build R&D centers, but to build the working capital required to build a data center. That's totally different. That requires huge amount of money.
Yeah.
And with that, we are going to work with SoftBank.
What are the biggest challenges with scaling up in the US?
Shortage of labor. As I mentioned to you, it's not the labor cost, it's a shortage of labor. Yes.
How do you get around that? What are the conversations like, and what are the biggest shortfalls that you see?
Yeah, we had to work closely with schools and the government, which we were very familiar with when we build factories all over the world. We had to work with local agencies or local government to get their people ready for the kind of job that we require.
Foxconn Chairman Young Liu speaking with Bloomberg's Annabelle Drewlers there. For perspective on how the AI boom and bubble fears are reshaping markets and investor sentiment, let's bring in Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management, Hong Kong. Grace, great to have you with us. I mean, we are seeing this optimism around AI, but also fears of a bubble in AI completely splitting markets at this point. Do you think that there are more gains to be had in this sector?
We're actually still positive on the AI story. We think the AI party is not over. Of course, there are some concerns, especially for the U.S. AI names that, with the valuations, which are pretty stretched. We actually think that when you look at like the earnings data, they are still like supportive. To the AI names, and we also think think that the recent correction actually is pretty healthy. As you know, this year actually especially the U.S. AI related names, they have a very good run already, and the recent corrections actually is healthy, and this is good, and it's actually overdue, and we actually think that any more pullbacks are actually buying opportunities. Yeah.
And when you talk about AI names, are we talking more about the big tech giants in the U.S. or Chinese names as well?
Yeah, I think for the U.S. names, we continue to like, especially we think, as I mentioned, there's like earnings support, and also like even people worried about whether they have a massive capex and whether they are going to deliver like the ROI. But so far, we think that they are okay, and utilization rate is actually high, so that's actually supportive for the capex. But on the China side, we also like the China AI names, because compared to the U.S. names, they're actually in terms of valuations more reasonable. And of course, this week we're going to see a couple of them. Earnings results, and let's see. And they're going to give like guidance. Whether the momentum is going to go forward. But we actually think that especially for the China AI names, given they actually have a separate AI ecosystem, and in terms of they're actually also more in terms of cost efficiencies, it's better. So with the increasing AI demands, and that would also means the increasing need for all the from infrastructures to a lot of the adoptions or applications.
Yeah, we actually heard that the Qwen app from Alibaba drew 10 million downloads. So we're seeing the stock now extending gains in Hong Kong. But this also means a lot of investments, right, around artificial intelligence going in order to get this sort of result. The diminished cash flow from the likes of Alibaba, Meituan, for example, JD.com, how problematic could it be when it comes to supporting the sector?
Yeah, I think it also comes to the earnings, right? Whether there is of course, because of the capex and that they have less cash flows. But on the other hand, it depends really on the upcoming earnings, whether we have the visibilities, and whether the strong earnings are sustainable.
When it comes to the Chinese AI names, what about the other names across Northeast Asia, for example, where we're seeing the semiconductor names, anything related to AI and how to build the AI infrastructure? Can we see more upside in these names when we've already had such a big run-up, especially in South Korea and the likes of, for example, SK Hynix?
Yeah, I think for some of the North Asia semiconductors, their correlations with the U.S. market, especially the U.S. big tech names, is actually very high, and that's why we also have seen quite significant correction recently. But as I mentioned, we don't think the AI story is over yet. There is still a lot of demand for semiconductors. And when we also look at the Taiwan or South Korea's export data, on the semiconductors, and still very good, very strong. So we think this is just a corrections, but as you know, compared to the AI names, the Korean names or the Taiwan names, they're actually higher correlation versus the China AI name versus the U.S. AI names. Yeah.
Grace, good to get your thoughts on artificial intelligence and the broader tech sector. Grace Tam from BNP Paribas Wealth Management Hong Kong is actually staying with us, and we'll be looking at the broader markets. So we'll be back with those outlooks on gold and other sectors of the economy as well. This is Bloomberg. Here's what's on the agenda in a busy week ahead. The Reserve Bank of New Zealand is expected to cut again as growth stays weak. Meanwhile, the Bank of Korea and Sri Lanka's central bank are likely to keep rates unchanged as policymakers tread carefully after earlier cuts. India will report third-quarter GDP on Friday. Bloomberg Economics sees India's economy slowing during the period. Let's bring back Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management Hong Kong. Grace, what will be driving the markets in the next couple of weeks? Given that we already talked about the artificial intelligence exuberance, we're now focusing on the monetary paths, but what's important in Asia?
Yeah, we're actually still positive, especially on the risk asset, including the Asian assets. Given, as you know, for the U.S., they are going. From our expectations, we think they're going to continue to cut interest rate in December and actually more in 2026. And for our base case, is 2 more cuts in next year. And so we also will see like the end of QT. In December. So that also means like the loosening financial conditions and also liquidity is going to be abundant. And that's, of course, favored risk assets. And furthermore, as I mentioned earlier, corporate earnings actually pretty solid. And also like, the retail investor sentiments also actually pretty good. And also, for the share buybacks, we think it will continue, and that also very supportive, especially for the equity market. So overall, we are still like overweight global equities, and we always think any pullbacks are actually buying opportunities.
Does that mean that we're going to see less haven flows into gold?
Yeah, gold actually has a very fantastic run this year. And in the fourth quarter, we actually have been seeing some consolidation. For now, in the short term, we're actually neutral gold, precious metals, silver as well. Because, we think, especially after the strong rally, we could see some like kind of healthy corrections or consolidations. But again, any like pullbacks, corrections, in precious metals, gold, silver, that should be a buying opportunity because, we think longer term, we're still actually pretty bullish. We think there is still a lot of demand, structural demand from central banks and also demand from a lot of investors and even for jewelry.
Yeah, gold has been a good hedge for geopolitical risk as well, right? When it comes to the China-Japan ongoing diplomatic spat, who's faring better? Because we're seeing some resilience in the Chinese stock markets, it seems.
Yeah, we think that the uncertainty could go on for some time, and that could also trigger volatility, especially for Japan market. As you know, those like tourism and also the retail stocks actually badly hit. And for Japan, we actually prefer more on the bank sectors and also the industrial sectors. Because for the banks, as you know, Takaichi, the governments, they just announced the massive fiscal stimulus, and that's actually, of course, could support the domestic demand of the economies. But at the same time, yields may continue to rise, and that actually favors the banking sectors. And for the industrials, of course, there is more demand like for automations, for like the robotics, etc. So we think, that sectors, could deliver like more visible earnings, going forward.
Yeah. Grace Tam, good to have you with us, Chief Investment Advisor at BNP Paribas Wealth Management, Hong Kong. Let's get a look at the India markets on a day where we have seen incredible pressure on the Indian rupee and the RBI, according to traders, selling dollars offshore to support the currency. We have already heard from the RBI Governor Malhotra that pressure on the rupee would ease once the country clinched a good trade deal with the U.S. Of course, that continues to be delayed, and we are seeing 50% tariffs on Indian exports. The Sensex is up 0.2%, and the Nifty also reversing some of those losses from Friday. But for more on the rupee, Bloomberg Chief FX and Rates Correspondent Ruth Carson joins us now with the latest. Ruth, what's driving this incredible weakness in the Indian currency?
Yeah, absolutely. All eyes on INR. We are seeing pressure. We are seeing, according to traders, also involvement by the RBI to defend the currency. A lot of it has come down to sentiment. It's as simple as that. India has the highest of all tariffs among Asian nations. There is still a trade deal to be meted out somehow. And until then, we're going to see pressure on the INR. Now, we've seen, obviously, INR break through the 89 mark. People are now talking about 90. And I think it was great when I was speaking to a chief investment officer earlier this morning. He gave great color on trading India as a whole. There are options out there that could be better. Clearer paths when it comes to trade, clearer paths when it comes to macro, even rates. So as a result, trading the rupee, the Indian rupee, is becoming harder. So don't touch it. And as such, we are seeing that pressure playing out. But that's just one example of investors looking at the rupee.
Also pressure on the Japanese yen. I mean, the stock market closed today, but when it comes to the yen, we're talking 156, 157, 158, even 160 being mentioned at this point. This sell Japan trade continues.
Absolutely. Two words when it comes to FX traders when I speak with them, it's intervention watch. When it comes to the yen. But still, we've seen, jawboning from the officials. We've seen, repeated warnings that, this yen weakness can't be tolerated too much. Yet, dollar yen keeps grinding higher. It comes down to rate differentials. It comes down to the fact that macro traders are still saying the Bank of Japan is slow when it comes to raising interest rates. Now, also remember, as was talked about earlier, Senator Takaichi unveiled a $17.7 trillion stimulus package late last week. Now, most bond investors that I speak with, they're comfortable between 14 to 15. So that's above. We know that means pressure on yields. We know that means weakness for the yen.
What should we be watching out for when markets return tomorrow here in Japan?
On the macro side, definitely still dollar yen. Keep an eye on euro yen as well. And obviously JGB yields, which has been under pressure because we know that inflation has been trending, 2% above the central bank's target now, not for months, for years. So that narrative hasn't changed, and we know that liquidity is thinner now with Tokyo out on holidays. When that liquidity comes whooshing back tomorrow, let's see where dollar yen will be headed.
Bloomberg Chief FX and Rates Correspondent Ruth Carson there. And let's turn to China because some of the local government financing vehicles known as LGFVs are said to have sold over $3 billion of bonds in Hong Kong by offering returns that can be double the official interest rate listed. That's according to some investors and bankers that we spoke with. For more, Bloomberg's John Liu joins us now from Beijing. John, explain to us this practice because we understand the regulators cracked down on it already in mainland China.
So I think we have to start with the motivation for these local financing vehicles. They need money to build roads, to build bridges, to do all these projects at the local level. Their revenues, their cash flow are not that strong. And so to get creditors, to get investors to lend them, to buy their bonds, to lend them their money, they need to offer relatively higher rates. But these vehicles don't want to offer those rates officially because they're worried if they offer 16% returns now, it means in the future when they come back for more money from the bond market, they're going to have to offer that again. And so their solution has been to sell bonds at an 8% coupon, but then offer consulting fees paid sort of off the books to the investors, or even money diverted to the banks that are helping do the deal, and those banks then in turn diverting that money to the investors. And so ultimately it's giving investors more returns so they'll buy the bonds, and it's helping these local vehicles raise money that they otherwise may not be able to raise.
It's so interesting. So they don't want to set precedent, but they're using every tool available in order to make these deals go through. How much do local governments actually know about this fundraising practice?
So this is a little unclear. We know that onshore in China, that the regulator has cracked down on this after finding out about this practice. And so we feel pretty sure that local governments are aware that some of these practices were happening. How much are the local governments aware that these financing vehicles have in turn moved that practice to Hong Kong to evade the mainland regulators? That's unclear. And what's unclear is how much Hong Kong regulators know and how much Hong Kong regulators will also start to crack down as they learn more.
Tell us a little bit about these LGFVs, because they started working about 3 decades ago. They were supposed to help provinces and cities. How successful have they been?
Well, LGFVs have been a huge part of the way that China has been able to grow its economy, especially at the local level. They started because the central government actually barred local governments from directly borrowing from the bond market and borrowing from banks. And so this was sort of a way to bypass that policy and help local governments find another way to raise revenue, to raise financing, to pay for things like roads and bridges and ports and airports, all of these types of projects. They've been super important, and now with the property market having suffered through this long wave of this long downturn that we've had over the last 3 years, local governments have really seen a drop off in their revenues, and that has in turn led to these LGFVs becoming more important, but at the same time being less sort of resilient when it comes to their finances.
We have industrial profit growth in China this week. What's been the state of the Chinese economy and some of the latest data that we've gotten for signals of where China is headed?
So I think the thing that really caught people's attention in the October data that we got earlier this month was the big drop-off that we saw in investment. We're not totally sure why that drop-off occurred. It was the biggest drop-off since during the start of COVID back in 2020. What some economists have sort of guessed is that partly local governments have, instead of spending their money on new projects, they've been using that money to pay back arrears that they owed to suppliers. There's also been talk that local governments have been holding off because they're having a hard time finding new projects that they want to put their money in. And also with prices falling here in China, that could also be playing into the drop-off in investment. And so that has people worried about the future, because investment in China is a huge part of GDP growth. And if that starts to falter with a little bit of weakness we've seen in exports and the continued weakness we've seen in domestic consumption, that spells a challenging picture going into 2026.
John Liu, Bloomberg Executive Editor, good to have you with us. Of course, John just mentioned those investments in China. We've been watching AI investments really happen across the board in the Chinese economy as well, and we'll be awaiting those results coming from Alibaba and Meituan later this week. And you can see right now the market's pointing to upside, 0.6%. China went on a lunch break with gains for the Hang Seng of more than 1%. And you can see the Kospi also gaining 0.7%. A lot to do really with that chip trade, semiconductors, a tech narrative as well. We have heard from the Trump administration, Bloomberg reporting that potentially they could let NVIDIA sell their H200 AI chips to China. So what that means for the Chinese semiconductors, not to mention the broader Asia tech market, is key at this point. And you can see U.S. futures also pointing to some upside. And we had seen Wall Street under a little bit of pressure last week, but then a turnaround towards the latter part of the week, hopes of a Fed rate cut, and not to mention, of course, those comments coming from the Trump administration on the NVIDIA really helping sentiment across the board. We have more to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Take a look at how the markets across Asia are trading today. We are seeing some broad upside, some optimism coming from Wall Street on more dovish Fed speak. Not to mention that we're digesting the potential news that the U.S. could allow NVIDIA to sell some of its AI chips to China. We're watching the semiconductor space very closely. Japan away on holidays, but we're watching the weakness on the Japanese yen, also weakness on the Korean won. We're on intervention watch in these two markets. markets. Already we are hearing that when it comes to the rupee that has fallen to a record low against the US dollar, that the RBI is selling dollars offshore to support the currency, according to traders. We're also watching one stock, the world's largest PC maker, stockpiling memory and other critical components to navigate a supply crunch brought on by the boom in artificial intelligence. Lenovo saying that surging AI demand is pushing prices way higher, but earlier CFO Winston Cheng told us the company has enough inventory to keep costs steady through the holiday season.
Yeah, we've actually have a lot of experience navigating through different supply and demand dynamics. Of course, the COVID period being one. And of course, I think also 10 years ago, I think there's also some shocks in the market. I think with respect to this current environment, our revenue gains and our market share gains have been very, very significant part of this, because if you recall, back in June, probably a lot of people were talking about pull ahead demand from the U.S., especially with respect to the tariffs, and therefore they were seeing a second half probably slow down. Now, we were really questioning whether the market was right and we were the one wrong, but we continue to see order load very strong, and you see that in terms of a September quarter being very, very strong. And we capture a global market share, the highest ever, 25.6%, right? Even higher on the AIPC front, on the 31% share. So on the back of those strong revenue growth, we've been engaging with the suppliers, so continue to buy. And so I think that's been very helpful. We also saw memory prices going up, and so for us, we also been holding longer weeks of inventory in terms of critical components. So I think that's also there to position to fuel our growth going forward as well.
What financial assumptions are you making going into next year? Whether or not you've secured that inventory or you locked in those futures prices on memory chips and that key cost component?
Yeah. I think the market is worried about cost and therefore damage on the margins, right?
Yes.
But I think overall, if you think about the other dynamics, which would be then the supply. So those that have the supply actually then would be able to have a position in the market. And I think we would actually say that potentially there's margin opportunities there as well.
So what does that stockpiling look like, though? You're talking how many more weeks or months are you keeping those inventory levels?
I would say that we're probably over 50% of our usual levels.
Oh.
So I think it's a significant in terms of our weeks of inventory as it relates to critical components.
And what sort of pricing advantage do you expect that to give you then? Like, what price did you lock in at? And what's, again, going back to assumptions, where do you think prices will trend?
Well, the prices are going very, very high, of course. And I think it's been unprecedented in terms of this rate driven by the AI demand. So I think this is probably going to be a longer trend. But I think overall in the next, certainly for the remaining of our fiscal year, which is another 6 months away, plus we've got longer term contracts also in place. So I think from that perspective, we feel quite comfortable. Now, in terms of the pricing dynamics, I think currently we're there to commit based on our scale. We can deliver the best price to the market, right, and also benefit our customers.
It seems very clear from the earnings call and also just your comments now that, and correct me if I'm wrong, that of any of your peers, you're probably in the best position to, let's say, manage that upward increase in cost pressures. So the next 6 months, this fiscal year, can I ask a direct question? Are you raising prices or not raising prices on the back of those costs? What's the plan? For us, we've been looking at potentially, depending on the channel inventory levels and other aspects, we would then adjust accordingly. For the near quarter, in terms of the fourth quarter of the current calendar year, we're probably thinking that it's still very strong in terms of the market growth for us relative to the rest of the market. We've been going very strong premium to market. So from that perspective, we can still lend our scale, especially coming to the holiday season. I think we want to make sure that we make sure everybody have a very good holiday season to the products that they can buy. So I think we will try to maintain that price. Understood.
But going into 2026, you are planning price hikes?
I think going on to it, given that overall the prices are going significantly, I think we will have to strike that balance going forward. But I think, again, I mentioned it's between price and availability.
Lenovo CFO Winston Cheng there. And we're looking ahead to earnings from Alibaba. Its stock is surging today after the company confirmed their Qwen app, a rebranded AI tool designed to rival ChatGPT, hit 10 million downloads in the week after it became available to the public. For more on Alibaba's outlook, let's bring in Bloomberg Intelligence senior analyst Robert Lee. Rob, how significant are these download figures for Qwen? I guess in the broader context of whether or not Alibaba's spending on artificial intelligence is finally starting to pay off.
Okay, great question. Well, Qwen, I think, as you said in your intro, is not actually a new product. They've revamped it and positioned it as a potential rival to ChatGPT in the China market. So the download numbers speak for themselves. The rebranded product has obviously got off to a good start. But I think, for those who are less familiar with the China software and internet sector, you have to understand that the basic version of this tool is actually available for free. It's only the premium version which is charged for. And if you look back at some iOS data over the course of the last year, this is on the pre-rebranding, that tool was generating less than $1 million revenue on the iOS system per month. So the level of monetization was low. Undoubtedly, it's going to pick up, but I think in the context of a huge Goliath, a huge beast that is Alibaba, it's highly unlikely to move the needle. But to end on a positive, at least it demonstrates that Alibaba continues to innovate at the leading edge and is well placed to, as a leading software company within the China market context.
Especially when the narrative around artificial intelligence and how Alibaba is using it, even in its cloud business, is going to help that sector?
Yeah, well, the numbers are out on Alibaba, Q3 results tomorrow, and I think the headlines on cloud are going to dominate again. But let's just take a step back from those for a second, because in common with most cloud companies, the levels of CapEx have increased significantly. So for this financial year and next, Alibaba is going to spend somewhere between $15 to $16 billion on CapEx. But then if you look at the incremental increase in their cloud profitability, in other words, the annual increase, it's only about $600 million. So I would argue that's a pretty poor return on investment. And then the other thing people need to bear in mind is obviously this very heavy level of CapEx investment is impacting their free cash flow generation. So again, just to quote a quick number at you, in 2024, Alibaba's free cash flow was around $21 billion US. In the current financial year, it's going to be between $3 to $4 billion. That's the impact of this heavy AI investment and heavy AI capex load at a time when they're not really monetizing it to any significant degree. And based on our view, given the intense level of pricing competition, intense competitive dynamics in the China market, when you're giving many of these tools to users for free, we're not going to see that monetization come through anytime soon.
Yeah, and that pricing competition expected to hurt Meituan as well, right? What are we expecting from the results this week?
Okay, well, if you cast your mind back, they had weak results. The consensus numbers have been brought down somewhere in the magnitude of 60% since year to date. So there's been heavy downgrades in terms of estimates. And in fact, Meituan will be loss-making both in this quarter and for the year as a whole. Consensus is looking for a rebound into next year. That remains in question. I'm sure there will be some rebound driven by cost cutting, but obviously it's a hyper-competitive market in the food delivery and mainstream local delivery market in China. In addition, Meituan is also investing heavily in the Gulf region. Those businesses are loss-making at the moment, so that's an additional burden on its bottom line. So I think, again, compare and contrast Alibaba and Meituan. Alibaba at least has a substantial market share in e-commerce, although given the levels of high competition, it's defending those through subsidies and price cuts, so there's a risk to Alibaba's margin, whereas Meituan is much more weakly positioned. It's a more narrowly focused business, and as I said, with the investment spend in the Gulf and also a lot of very heavy price competition in the delivery market, I think there's ongoing risk on their estimates.
How much impact and potentially upside are we seeing from Beijing's own efforts in this anti-involution campaign in order to limit these price wars?
Well, that's a great question. We're not seeing the anti-evolution measures impact the software and AI sector. But I think, as I've said previously, at the last count, there are more than, or in fact, close to 540 large language models in China, with a very low level of differentiation between these products. So I think by most people's definition, there's massive oversupply. So we need to see a consolidation in that sector to help put it on on a profit footing. But more importantly, going back to what I said on Alibaba at the moment, most of these AI tools in China are available for free. So there is quite literally no monetization at the moment, and everybody is employing and playing the same game, same strategy, hoping that the weaker hands are going to fall by the wayside. But when you've got dozens of companies or even hundreds of companies employing the same strategy in a market flooded with supply, with low level of product differentiation, with a lack of killer apps out there at the moment, it's incredibly hard to see how things will change in the near term. So the government, maybe it does take a firmer hand in trying to engender a sort of shakeout. But really, a shakeout and a consolidation is definitely what's needed in the China AI sector to at least give the sector a better prospect of finally at least breaking even, let alone breaking into profit.
Bloomberg Intelligence senior analyst Robert Lee, really good to get your insights. Let's actually get more perspective with Si Fu as well, China portfolio strategist at Goldman Sachs. Si, great to have you with us. You just heard from Robert, really the competitive challenges in the Chinese market when it comes to these anti-involution efforts by Beijing, still not working on a market that's really driven by a lot of supply and perhaps little differentiation when it comes to products. How much of a challenge will this be for the Chinese market?
Yeah, if we look at the past 5 years, a lot of involuted sectors have margins significantly below their historical average. So that is still a challenge for many of the upstream sectors. But since this July, we've already seen the policy have emphasized the anti-evolution efforts. So we've already seen some upstream sector begin to recover a little bit with price stabilize, with some company begin to cut their capex. So anti-evolution efforts is what we expect to continue driving some margin improvement for these sectors and also boost the earnings of the overall market if the efforts can make some impact.
Yeah, we're expecting Alibaba and Meituan results this week. What are we expecting to see when it comes to that downside pressure from all of the competition?
Yeah, definitely the competition this year have dragged the earnings of these internet companies. As a whole for the MSCI universe, this year we only expect 4% earnings growth, mainly because of the competition of the internet space. But looking into the next year, we think it may begin to normalize. The third quarter is what we expect to be the worst quarter. And so coming into next year, we think most of the company will have earnings begin to gradually recover. For next year, we expect the whole universe of MSCI China to have 14% earnings growth, assuming the internet sector will have more normalized earnings. At the same time, we do see AI is boosting earnings from both the capex perspective as well as the productivity improvements. So definitely, if we look at the internet sector, not only about the competition, about e-commerce, but at the same time, we also need to consider their potential in terms of AI adoption, how it may contribute to their future earnings growth.
Interesting. Are you already seeing the results of the AI adoption when it comes to productivity in some of these companies? Because so far, we have continued to talk about the incredible investments that this sector is taking and potentially draining some of the cash flow of these big tech giants.
Currently, if we look at AI adoption, we think that most investors are considering the upstream investment opportunities that are coming from AI capex, which has higher visibility. So far, we've already seen the AI capex of these internet companies pick up, and we also see demand from the semiconductor sectors have also picked up in terms of the stock performance. We've already seen the result. So that has higher visibility. security. But on top of that, we also see some development in terms of softwares, in terms of AI-related services. Although some of them are provided for free or the monetization remains a question, but definitely adoption rate is pretty high in the China market. So that gives us more hope for the future productivity improvements if it's AI applied to different sectors, including like financials, professional services, or other services-related sectors. So that is what we have a higher expectation in the future. Definitely productivity improvement will boost earnings.
How positive is it that the Qwen app from Alibaba drew already 10 million downloads? Does that give you more optimism about how potentially the monetization of this sector could evolve from here?
I think it's still a little bit early to evaluate the monetization potential. Still, the sector where the AI-related potential is dynamic. We see different emerging, like new competitors or like new leaders in the industry. So I think it's still a little bit early for us to give numerical targets, but what we are seeing is a lot of companies are making investment in these areas, and definitely achievements have been made. So that is what we are expecting to boost the earnings of the overall market. Our estimation is the AI adoption in general will boost the earnings of MSCI China by 3% each year in the coming 3 to 5 years.
And so you mentioned earlier the semiconductor side of things when it comes to this infrastructure build-out. We heard that the Trump administration is considering potentially allowing NVIDIA to sell its H200 chips into China. What does this mean for local makers? Does this apply more downside pressure and competition, or does Beijing not care, given that Beijing has given the directive to not rely on U.S. technology?
Definitely, if this is the development, I think it will be welcomed by these like tech companies, because still a lot of them really need like the high-end chips. But at the same time, I don't think it will stop the domestic development in terms of chips, because there are a lot of different demands coming as AI adoption is improving. So if we look at the domestic players, especially the semiconductor ones, we still think they are going to grow their business to meet the different more diversified demand domestically. And from the government perspective, definitely they will continue encouraging all this development. If we look at the 15th five-year plan, clearly technology and security are the top priorities. So I think from that perspective, regulators will continue encouraging all the domestic development.
Si Fu, good to have you with us. China portfolio strategist at Goldman Sachs with an in-depth look of the Chinese markets. Of course, we have plenty of earnings out of China this week. We're also watching the Indian market because we're now hearing that the RBI sold dollars onshore in order to support the rupee. This coming from traders. Earlier, just a few minutes ago, we had also heard from traders that the RBI was selling dollars offshore in order to support the currency. Of course, we were wondering where the central bank was in the past day after the rupee breached that 89 mark against the dollar. And we failed to see that aggressive intervention that we had seen back in mid-October, and that spurred again another leg lower for the rupee, which tumbled to an all-time low. And we're now hearing from traders that the RBI is selling dollars onshore and offshore in order to support the currency. Still ahead this hour, India and Canada agreed to resume discussions on a bilateral free trade deal in the latest sign of warming ties. Details next. This is Bloomberg. Indian Prime Minister Narendra Modi and his Canadian counterpart Mark Carney have agreed to restart trade talks. It's the latest sign of warming relations between the two countries. Bloomberg's Shruti Srivastava joins us from New Delhi. Shruti, so how big of a turnaround is this for diplomatic ties after tensions flared up back in 2023?
So So definitely this is a big turnaround. Let's get some context first. So India and Canada have shared a very rocky relationship since 2023, when the then Prime Minister Justin Trudeau, he publicly accused India of orchestrating the killing of a Sikh activist in the Vancouver region. Of course, the Prime Minister Narendra Modi's government denied that, and ever since then, both the nations paused their trade talks. There was a lot of diplomatic tensions, and the relationship basically soured. But ever since Prime Minister Mark Carney, he took over in March, he has tried to restore and normalize the diplomatic relationship between the two nations. We have seen that both the nations, they have, restored their envoys in each other's country. And this month, we also saw Foreign Minister Jaishankar, he visited Canada and he spoke to his counterpart, while the Canadian Trade Minister was in India this month itself, and he met his counterpart in New Delhi. So clearly a lot has changed ever since the two shared a rocky relationship, and I believe much of this has to do with the fact that Trump's tariff and trade policies, they have upended the global commerce, and they have left the country scrambling to find, newer markets, diversify their exports, and shield their economies from the tariff onslaught, essentially. So this is essentially a big diplomatic, warming of ties between the two nations. Resumption of trade talks clearly signals that reset in the bilateral relationship.
Yeah, sure. I mean, U.S. tariffs are 50% for Indian exports, really not great. So not surprising that these two countries are trying to get closer together. But how important are they to each other economically?
So let's be very clear. As of now, India and Canada don't have, substantial trade. In 2024, the total bilateral trade that stood at around $24 billion. And with the free trade agreement that the two sides, they have, announced the resumption of the trade negotiations, they aim to take it to $50 billion by 2030. But this is a huge signal of sorts. How the Trump's policies are essentially putting countries together to come as one force and try and find newer markets, diversify their products. Canada is U.S. second largest trading partner, and for India, the U.S. market, India ships 1/5 of its exports to the U.S. So U.S. is clearly a very important market for both these nations. Now that the U.S. is, it's become uncompetitive for Indian exporters, and U.S. has halted trade talks with Canada. I think it makes sense for both these nations to come and revive trade talks and see how much can they increase their trade, bilaterally.
Bloomberg Srivastava, good to have you with us, joining us from New Delhi. And we continue to watch U.S. futures at the moment after we saw that upside in the Friday session as well, and continuing those gains in the future session early on Monday. This, of course, after that turnaround last week, we heard some more dovish Fed speak, especially from the New York Fed President John Williams, that sometimes is seen as a proxy for Fed Chair Powell. We also had that potentially positive news on NVIDIA being allowed to sell chips to China. Coming up, Ascertis Credit weighs in on the outlook for India's private credit market. This is Bloomberg. Welcome back. You're watching Insight. We're seeing some fragile gains across Asia today. Japan away on holidays, but the Kospi gaining a little bit of ground after, and also reversing some of those earlier gains as well. But we're still holding above water for the Kospi. And the Korean won and the Japanese yen continuing to weaken. So we continue to watch, of course, a downside pressure on the Asian currencies, as we've seen the U.S. dollar firm up a little bit in the last few sessions. So intervention watch is very key at the moment, especially in the likes of the Indian market. We're tracking Indian markets about 45 minutes into the start of trading already, and we heard that the RBI has sold dollars onshore and offshore to support the currency. This is according to traders who had been a little bit surprised earlier in the week because policymakers hadn't actually intervened in the markets and tried to prop up the rupee, which led to the rupee falling through that 89 per dollar level. So after that aggressive intervention around mid-October, we're now continuing to see more action coming from the central bank. And you can see right now the Sensex and the Nifty gaining ground. In fact, it's the tech and financial sectors that are leading the gains. Global investment funds are driving also the boom in India's private credit market, taking a 68% share of the $9 billion in such deals struck in the 6 months through June. Ascertis Credit, a Singapore and India-based private credit platform, has announced the first close of its $1 billion fund, raising $520 million, the largest first close ever achieved in India's private credit market. Let's get perspective from Kanchan Jain, head of Ascertis Credit. Kanchan, great to have you with us. What's driving the exuberance when it comes to private credit in India?
Hi, Sherry. Thanks for having me. I think multiple things, really. At the end of the day, I think private credit, plays a very important role in providing an additional source of non-dilutive capital to companies that are looking at very high growth rates. And I think that's one of the key focus areas. And I think our sort of current first close is quite significant in a couple of ways. I think firstly, we look at Asia credit growing at, say, 14-15% CAGR, which in itself is attractive. But when you look at what the constituents are, it becomes even more interesting, right? So 5 years ago, Asia credit was 60% China, 20% Australia, and a sprinkling of India and Southeast Asia. I think today, Australia and India account for more than half of the market. So India has really gone from being 5-6 billion to 25 plus, so thereabouts. Really good regulation, stable regulation for alternative investment funds, good returns, good underlying growth, and I think that's what's driving it. What's interesting also is Asia credit used to be a special sits market till about 10 years back. And I think performing credit strategies, which is what we do, otherwise, don't necessarily promise 20% returns, but mid-dollar returns, lower end for a market like Australia, higher end for a market like India. And I think it's the nuanced view that investors are taking. And I think that's probably one of the most significant things for Asia credit in general, that investors are willing to look at the underlying investment opportunities profile and then look at what the return is, as opposed to a blanket Asia risk premium applied to everything.
When it comes to India's credit market, where are you seeing the biggest opportunities when it comes to the different sectors at play?
So, of course, I think, credit opportunities in India really are sector agnostic right now, right? Because it's about really what sectors are driving growth. And I think, yes, the consumption, story, has been a little bit slow. But outside of that, I think there has been very significant growth. And you're talking sort of more longer term trends here, right? Whether it's infrastructure, government spend, private capex, or even the trends, that have come out of tailwinds, out of supply chain diversification. So I think all of these are growth areas. There are opportunities around acquisitions, market expansion, and not all of this can be met through bank lending, right? That's a wholesale lending model. So really, for us also, the approach is very much sector agnostic. And I think that's where the opportunity lies as well.
When it comes to acquisition financing, how flexible could these funds be in order to be attractive?
So funds actually play a big role. And in fact, I think globally, banks do some acquisition finance, but there's always been some kind of central bank restriction on that. We've seen the same in India. There's been a welcome move recently about, the RBI re-looking at those norms and opening it up for banks in some way. And that's great because I think that just brings more capital into the system, and we believe it's going to create a surge in M&A activity. And there's opportunity for both funds that can be super flexible in terms of looking at the risk and return profile, have the ability to look at more complex, transactions, multiple entities that are involved in typical M&A transactions, but also having bank credit in there, which brings the cost down and provides more flexibility. And I think that kind of blended capital is actually very important for M&A activity.
And Kanchan, whether it's the warnings coming from Jamie Dimon's cockroaches comments or Jeffrey Gundlach talking about garbage lending, are there any of those concerns reflected in the Asian private credit sector as well, and specifically in India?
So no, I think the biggest, important thing about Asia private credit is that it's actually very different from what we see in the US. Right. In the US, the market's largely been led by sponsor lending. So private credit has, been about providing leverage to sponsors or sponsor companies. Whereas I think in Asia, most of the underlying market is non-sponsor market, and performing credit is really providing real growth capex to these companies for growth. And I think it's over and above bank credit, right? It's not it's not going into spaces where bank credit is withdrawing. It's actually meeting, one, a shortage of capital that's there in Asian economies. Two, it's providing a different form of financing that wholesale lending can't provide. So I think it's playing a very different role. And just to set the context here, I think even in the US, the private credit market is less than 10%. So I think the risk of systemic risk concerns, a little bit, I would say, overblown. There are other areas, things like valuations, things like certain vintages that may result in higher default rates. I think in Asia, and I think if you look at India, you're looking at 1% today, right? So Asian private credit or Indian private credit is about 1 to 1.5%. So we are not anywhere near the levels where we need to be concerned. In fact, it's a very big opportunity for Asia, right? We can look at everything that private credit brings to the market, learn a little bit from US experience, build in those guardrails, and take advantage of very significant mobilization of capital that can happen for Asian economies.
In that sense, the fact that the private markets are so small and also that the deal sizes might be small and the volumes also much smaller than what we see in the U.S., is that a risk or an opportunity?
Well, some of it is peculiarity of the Indian markets or Asian market, Sherry, and I think you raise a very important point. You know, in the US, sort of a mid-market EBITDA is $50 to $70 million. And I think all of us know in most economies in Asia, at $50 to $70 million, you're actually looking at a very well-established business, right? So when we look at smaller deal sizes, I think it's to do just with the fact that dollar equivalent sizes of Asian businesses, Asian economies, are a slightly different benchmark. Having said that, I think, no, it's a positive because the way we use it with the smaller transaction sizes is that we're able to just create a much more granular portfolio, a more diversified portfolio. And I think that is something that investors, appreciate a lot when they invest in Asia. It's not necessarily negative. I think what we need to think about is that we will see a high year-on-year growth rate because we're growing from a very low base. That by itself is not a concern. So long as we can address things around just bring in good governance practices, look at valuations, bring in transparency and reporting, I think it's a very big opportunity for Asia.
How uniform is that transparency and that credibility across Asian markets? Because all of these countries differ so vastly.
So I think Asia, if you're doing Asian credit, typically you would do it, by creating structures that are based in either Hong Kong or based in Singapore. And Singapore has really emerged as one of, the stronger and one of the very important hubs for investment businesses. And I think within that, then there is a fair amount of transparency and reporting that's available in the structures. Similarly, in India, we now have gift city structures that people are using to raise offshore capital. Again, I think there's been huge strides in the last few years. Just as an example, the Indian regulator actually has a prescribed and a recommended valuation methodology that all of us as fund managers have to use. That itself is a very significant tool to ensure that there is a lot more transparency in the way these underlying investments are valued. I think individual economies may have some differences, but the move is in the right direction.
Kanchan, private market players always tout the fact that you can get alternative funding when it comes to the private markets and diversify your investments. But at the same time, when you have risks such as geopolitical risks, when you have fiscal risks across the world as well, and potentially just really black swans that we can't imagine with the ongoing concerns about an AI bubble, how concerned should investors be looking at private markets and their transparency and what sort of returns they could get in the next few years?
So I think risks around, geopolitics, just shifting geopolitics, tariffs, all of that, I think these are, incremental risks that we need to factor in. I think pretty much any investment manager need to be thinking about all of these risks that affect their business. I think we've done the same thing, right? You don't necessarily think that it's going to be resolved in 3 months or 6 months. It's just something to sort of take into account. I think the same thing goes with AI and tech enablement, that we feel that there is going to be a very significant shift in most underlying business models, and that is an essential factor in the way we analyze these things. I think private markets in general, when you look at, and this may be a pretty general statement, but I think it holds true, that when you look at a lot of uncertainty in the markets, the wholesale lending models need a lot more time to adjust to that. Bank lending, for instance, when you're looking at newer business models, business disruptions, or tariff-related disruptions, it sort of enters into a little bit of a more, risk-off mode. And I think that creates opportunities for private markets. So done well and done responsibly, private markets in general can take advantage of these kinds of, uncertainties and continue to make better returns and generate good liquidity premiums out of such situations.
Right. Kanchan, Jain, really good to get your insights. Head of Ascertis Credit here with, of course, a look at the private markets and some of those uncertainties that we're following, including the latest developments on peace talks in Ukraine. U.S. Secretary of State Marco Rubio says President Trump's proposed deadline to secure Ukraine's support for a U.S.-backed peace plan by Thursday isn't set in stone. According to the White House, Ukraine believes that the current U.S.-backed peace proposal reflects its national interests. Rubio's comment comes after U.S. and Ukrainian officials met on Sunday in Geneva, and European leaders discussed Trump's proposal on the sidelines of the G20.
Ukraine has never wanted this war, and we will never be an obstacle to peace. Diplomacy has been reinvigorated, and that's good, very good. We expect that the outcome will be the right steps. The first priority is a reliable peace, guaranteed security, respect for our people, respect for everyone who gave their life defending Ukraine against Russia aggression.
Finnish President Alexander Stubb says that together with Italian leader Giorgia Meloni, he spoke with President Trump about Washington's 28-point peace plan to end Russia's war in Ukraine. Stubb made the comments to Bloomberg's Jennifer Zabasaja on the sidelines of the G20 Leaders Summit in Johannesburg.
I think the plan has 3 levels. Number one is Ukraine. What happens to Ukraine? Land swaps, etc. Then level number 2 is Europe and European security, EU and NATO. And then level number 3 is the transatlantic partnership. So with these things, it takes time. That's why we have our national security advisors in Geneva today, speaking with Foreign Secretary Rubio, with Andrei Yermak and others. So, one day at a time.
Is there anything specific, though, you would like to address first?
No, I think, we work on this as a team. So that's why we had 11 countries from the Coalition of the Willing meeting here in Johannesburg yesterday, including Canada and Japan, who are strongly committed in finding a just and lasting peace in Ukraine. And we work on the text together, we negotiate together. And I don't want to lift up any specifics at this stage.
Do you believe this, though, was Europe being sidelined to a certain extent?
Well, I guess yes and no is the right answer. Yes, in the sense that we hadn't seen the document beforehand, but no, in the sense that now we're negotiating and discussing with our American friends and allies. So I'm not too concerned. I think quite often in these types of negotiations, you need patience. You need to be cool. You need to tone down the emotions. And I guess to a certain extent be a little bit more Finnish, and then you find a solution. You'll find the finishing line.
But you seem certain that this will not be the final agreement. Why are you so certain about that?
Well, we're here in the G20, right? And here a document was approved. The establishment of that document took months. So it's never the first draft that goes through. You have to do many different iterations. I think it doesn't matter whether you're a lawyer or whether you're in the news business. When you deal with contracts, it takes time.
Does that mean potential discussions with President Trump? You're known to speak to him often. Have you spoken to him this weekend?
Well, now that you ask, 10 minutes ago, Prime Minister Meloni and myself spoke with President Trump.
And what was the progress of those discussions? It's quite early in the U.S.
The President of the United States wakes up very early and he works very hard. And he wanted to talk about the plan and the state of play.
Are there more discussions planned this week? You mentioned Rubio is in Europe right now.
Yeah, I think right now we hand it over to our national security advisors in Geneva and Rubio and the Ukrainian team, and we see what comes out by the end of this evening.
Okay, so it's unlikely then that this Thursday supposed deadline will see a final agreement.
Well, it's difficult. I don't want to sort of preempt that. You never know with these kinds of negotiations. But I think the key right now would be to get a ceasefire.
That was the Finnish President Alexander Stubb speaking with Bloomberg's Jennifer Zabasaja. And here are some of the other top global stories that we're following. Israel says it's killed Hezbollah's military chief in a rare airstrike on Beirut as an almost year-old ceasefire deal with the Lebanese government wavers. The IDF says the attack killed Hezbollah's chief of general staff, Abu Ali al-Tabtabai, the militant group's second in command, according to Lebanon's health ministry. The strike left 5 people dead and 28 others injured. Severe flooding across central Vietnam has killed 90 people and left 12 others missing. Vietnam's Ministry of Agriculture and Environment says more than 1,100 homes were damaged and at least 80,000 hectares of rice and crops destroyed. Early estimates put the total economic damage at about $340 million. Coming up, Foxconn's Chairman Young Liu tells us how the firm is looking to grow its U.S. manufacturing footprint. More details ahead. This is Bloomberg. Foxconn is aiming to spend an initial $1 to $5 billion growing its U.S. manufacturing footprint. The expansion is aimed at meeting the needs of AI firms such as NVIDIA and OpenAI.
To keep pushing the frontier, we need to build these new types of AI infrastructure hardware at scale, and I'm excited for that to happen in the US and with Foxconn. Foxconn's experience building complex infrastructure and hardware at massive scale makes them the ideal partner for this, and I'm looking forward to exploring together what this can look like. We'll share insight into emerging hardware needs across the AI industry, and Foxconn will use that to design and prototype new equipment that can be manufactured in America.
Foxconn's Chairman Young Liu laid out the firm's plans with Bloomberg's Annabelle Jewelers.
A gigawatt per week will be the goal.
Okay, 1 gigawatt per week.
Per week. That will be same goal. Okay. But we can start with 1 gigawatt per month.
So you think you can add 1 gigawatt per month next year?
Starting the second half of the year.
Second half of the year, so you think you can add 6 gigawatts next year?
I'm not sure. It really depends on our study and our new way of doing things. It takes time, but eventually we're going to get there.
Let's talk about then this opportunity in the US, because as you said, the part of this is about Make in America. It's very ambitious. What's the capex that you need to also dedicate to the States?
The capex-wise, it's in maybe 1 to 5 billion to start with, to build the factories, to build R&D centers, but to build the working capital required to build a data center. That's totally different. That requires huge amount of money.
Yeah.
And with that, we are going to work with SoftBank.
Getting back to that $1 to $5 billion capex in the US, what sort of timeline is that spread over?
We want to happen as soon as possible.
And how are you going to finance that?
Foxconn itself is able to finance that.
What are the biggest challenges with scaling up in the US?
Shortage of labor. As I mentioned to you, it's not the labor cost, it's a shortage of labor.
How do you get around that? What are the conversations like, and what are the biggest shortfalls that you see?
Yeah, we had to work closely with schools and the government, which we were very familiar with when we build factories all over the world. We had to work with local agencies or local government to get their people ready for the kind of job that we require.
On the AI server production assembly side, because today you made that point that you're at 1,000 units a week. When it
1,000 racks.
1,000 racks, rather. Yeah, you can assemble 1,000 server racks per week right now. Next year, what does that look like in terms of your target?
I would say more than 50% of increase, up to 1,500 to 2,000 racks.
You think you can double it? That's within sight. Are the data centers ready though? Like is the financing in place?
The power.
Yeah, exactly.
I think the critical thing is the power. Yeah, I think all the data center users, they're all trying to secure power, right? So we found some progress there that for our data center user to secure the power. Because I'm running a data center, the data center users will be the one who's going to use the data center. So they have more say than us to work with the government for the power, because they're the one can commit, not us. You know what I mean? So they will, I think they have a way to work it out.
Their conversations to have. Okay.
Yes.
If your US factories are going to be highly automated, or they are highly automated, can be, do you see then moving other types of production to the US, consumer electronics and specifically smartphones? Could you shift some production there?
Oh, it's a totally different game. Because as I mentioned, for the servers, their unit cost is so high. The labor cost comparing to it is small percentage, right? But for smartphones, the unit cost, $500-600. So the labor cost, and also the number of units much higher. As I mentioned to you, 1 million phones a day, right? If it's $1 more, that means 1 million gone.
Yeah.
So this is a totally different game. But I think once we have some kind of infrastructure built in the States locally, that infrastructure, the cost of that infrastructure will become a leverage for other products to come.
Foxconn Chairman Young Liu with Bloomberg's Annabelle Jewelers there. And do keep an eye on Alibaba jumping at the moment on news that the Qwen app has gotten 10 million downloads in its first week. And of course, we're also gearing up for its earnings on Tuesday. That's it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.